Welcome all to this CoverTalk webinar today, where we'll be talking about war exclusions in cyber policies. My name is Suki Leung, and I'm a Senior Associate in the Insurance Disputes team. I'll be speaking today with my colleague, Jacqui, who is a Principal Associate in the Insurance Disputes team. Before we start, for housekeeping purposes, this session is being recorded, and whilst you can see us, we cannot see you. We may have time for a Q&A session at the end, so if you have any questions, please post them in the Q&A box at the bottom of your screen. My colleague and Senior Legal Advisor, Harriet Strevens, will pick them up for us at the end. Where we've run out of time, we'll deal with them separately after the session by email. Today, we're going to concentrate on the development of cyber war exclusions, which insurers and brokers are having to consider. And this will take us through the topics listed on the screen at present. I'll deal with the first two topics, followed by Jacqui, who will pick up the last three. As the majority, if not all of you will know, the topic is vast and has in recent times been controversially discussed, and no doubt these discussions will continue for some considerable time. However, we're not here to provide all the answers. Instead, we hope to highlight some of the difficulties and anomalies one might expect to have emerged in this arena, particularly given the changes and developments which have taken place since the 1930s, when one of the original war exclusion clauses was drafted. So to start, let's take a look at why a war exclusion was needed. NMA 0464 on your screen was one of the most commonly used war exclusions. The exclusion derived from the wording used in historic real property insurance policies. The language was drafted with traditional property risks in mind and with conventional warfare being the primary focus of the exclusion. The purpose of traditional war exclusions were to exclude from cover the risks associated with war. Those types of risks are generally large, systemic, catastrophic losses which the insurance market would not be able to sustain. Lloyd and others in the market had been concerned for some time that this clause, which dates back to the 1930s, did not sufficiently deal with and exclude the systemic risks posed by cyber attacks in a war context. Rapid advances in technology, the increased number of sophisticated attacks, and the development of the cyber landscape has meant that the traditional war exclusion is no longer adequate in the context of cyber insurance. For example, the traditional war exclusion has no connection with modern day activities. It doesn't exclude malware or ransom attacks because those types of risks just weren't envisaged when the clause was drafted. These inadequacies became more evident following the 2017 NotPetya state-backed cyber attack. Ukraine was the primary target of the NotPetya malware that was linked to the Russian government, but the virus spread far beyond the borders of Ukraine to more than 60 countries and thousands of multinationals. NotPetya was estimated to have caused over $10 billion of damage globally. It seems to have been the tipping point in the war exclusion history for two reasons. Firstly, it was one of the biggest, most globally widespread cyber attacks. It involved one state, Russia, attacking another state, Ukraine, in a warlike manner through the use of cyber, but it had massive global implications. You could say this was a wake-up call for some in the insurance industry to the systemic risk posed by cyber warfare. Some insurers attempted to apply the traditional war exclusion to exclude losses arising from the NotPetya attack. The most well-publicized, and I believe the only reported case on cyber war exclusions, is that of Merck International versus ACE and others. Merck, a pharmaceutical organization, was a victim that was affected by the NotPetya attack and suffered losses of $1.4 billion. Its insurers sought to rely on the war exclusion to deny the claim, arguing that the cyber attack amounted to a warlike action and any resultant damage was therefore excluded from cover. The New Jersey Superior Court, which is the court of first instance, ruled that the war exclusion did not apply because it did not make any reference to cyber. It considered that the failure of insurers to change their wordings, despite the increased frequency of cyber attacks, made it reasonable for Merck to consider The exclusion only applied to more traditional forms of warfare. Insurers appealed that decision, but in summer 2023, the New Jersey Appellate Division upheld the first instant court's decision that the war exclusion does not apply in the case of this cyber attack. Insurers have appealed to the New Jersey Supreme Court, so there could be further developments, and so this is one to keep an eye on. The NotPetya attack and the Merck decision highlighted the need for exclusion clauses that account for the evolving nature of risks in the modern world, particularly in the cyber realm. This concern was equally felt by Lloyd, particularly that the current wording of war risk exclusions in cyber insurance policies did not adequately address the inherent systemic loss risk associated with cyber threats. This ultimately led to Lloyd's issuing Bulletin Y5381 in August 2022, which set out 5 requirements that must be met by each Lloyd's insurer writing standalone cyber insurance policies. These are on your screen now, set out on the left of the table. In summary, a suitable exclusion clause needs to exclude losses arising from traditional war, exclude state-backed cyber attacks, contain collateral damage and attribution wording, and define all key terms. Those requirements became mandatory on 31st of March this year. It's only Lloyd's members that are subject to these requirements, not the company market or insurers in other jurisdictions. I'll now hand over to Jacqui to talk about the LMA cyber war exclusions that followed the bulletin.
Thanks, Suki. So to assist Lloyd insurers in understanding and developing cyber war exclusions, the LMA published various model clauses that seek to address the Lloyd's requirements. And whilst there were some earlier iterations of the clauses, the latest versions of the LMA's model clauses were published in January 2023, and they're listed at the top of the screen now. So broadly speaking, the clauses can be characterized as 5564 being the broadest exclusion, 5567 being the narrowest, and 5565 and 66 being the exclusions that fit somewhere in between that range. So the difference between the A and B versions of each clause is simply that wording regarding attribution has been removed from the B versions, and I'll touch on that a bit more later in this talk. So the use of these clauses is not compulsory, and indeed many insurers and brokers chose to develop clauses of their own. And if insurers do adopt alternative clauses, however, they still need to ensure that they meet the Lloyd's requirements. We haven't included the wording of each of the LMA exclusions on these slides. Each one is over a page long with various definitions and qualifications. Instead, we've included the substantive parts of the exclusion for the narrowest and broadest clauses, which you can see on the slides now. And what this doesn't include are all of the associated definitions and qualifications. So what you can see is that each exclusion starts with the same components. It excludes losses arising from war, and it excludes losses arising from a cyber operation, although the narrower clauses only exclude cyber operations in certain scenarios. A cyber operation is effectively the LMA's wording used to describe a state-backed cyber attack. And the difference between each clause is the circumstances in which losses arising from a cyber operation might be excluded. So for instance, the broadest exclusion, 5564, doesn't qualify at all what sort of cyber operation will be excluded. There are no exceptions. In contrast, the narrowest exclusion is more specific. Losses arising from a cyber operation will only be excluded if that cyber operation is carried out as part of a war or the immediate preparation of war, or if the cyber operation caused a state to become an impacted state. An impacted state is defined as a state that has suffered a major detrimental impact to its security or defense or to the functioning of the state. And that means the disruption to essential services, financial institutions, health services, etc. 5567 also carves out from the exclusion the collateral damage type losses. And by that, I mean where an insured suffers loss to computer systems that are located outside of an impacted state. But this doesn't apply to losses that arise from cyber operations that are carried out as part of a war. So how have these clauses been adopted and developed since they were published by the LMA? Well, there's been quite a lot of activity in the market in deciding how to develop and adopt the model clauses, and Lloyd has been involved in those developments and provided some further guidance to insurers. The clauses which we understand have been most commonly adopted by the market are the narrower exclusions, more akin to LMA 5567, A or B, or an adapted version of this clause. And the market now categorises the various clauses as type 1, 2, 3, 4, 5, but we don't intend to go through the different types of those today. So on the screen now, you'll see some of the sort of questions that have arisen during this period of development and what Lloyd's or the market has done to try to deal with these. We don't have time to go through all of these now, so I'm just going to discuss a few of them. So firstly, attribution. One of the early questions the market grappled with was how to deal with attribution wording. In other words, how an insurer proves that a cyber operation was state-backed. That's a difficult exercise given the level of anonymity associated with cyber attacks. There are questions around whether this should be by reference to governments attributing attacks to certain states, or whether it should be some other evidence that insurers can point to in order to show that an attack was state-backed. And whilst some preferred the certainty of the attribution wording in the LMA clauses, others raised concerns about its interpretation. So we've now got the B version of the LMA clauses, which don't include attribution wording. So insurers can adopt their own wording for attribution or seek an exemption from Lloyd's, such that no attribution language is required. Given the difficulties in attributing a cyber attack to a state, the general view that has been endorsed by those we have spoken to is that this is an issue for which we are not likely to have any certainty until it's been tested in court. And even then, it's highly fact sensitive, which is going to need some careful consideration in each case. So looking at carve-backs, some insurers have also looked at questions around what would happen if only one insured is impacted by a cyber operation, and have sought to provide cover for that by carving it out of the exclusion. Lloyd's, in response, has indicated that it potentially increases the risk that is covered, and you can see how that might be true. For instance, if a cyber attack took down the systems of a large utility company or another essential service, that's potentially only one insured, but could have a large impact on a state. And for that reason, Lloyd's has said that any insurers adopting such wording need to satisfy Lloyd's that they have sufficient underwriting controls in place to manage that risk. Other insurers have developed entirely different wording, which excludes losses arising from a widespread event rather than from a war or cyber operation. It doesn't require the cyber attack to be connected to a war or to be state-backed, and is instead dependent on the cyber attack reaching a certain threshold to be classified as a widespread event that therefore falls within the exclusion. That wording's also been considered by Lloyd's, who has indicated that insurers should consider applying sublimits for that type of cover, and it remains to be seen how far this wording will be adopted by the market. So what next? Well, we know from our discussions with the UK market that it's seen some US business transfer to US and cyber insurance market where the Lloyd's requirements aren't, where they're not subject to the Lloyd's requirements. But the UK market's view appears to be that this will level out across the next year. There are insurers in other jurisdictions, including the US, that have already adopted wording that excludes war risks in a similar way to the LMA clauses. Indeed, some have reported that brokers and clients welcomed the increased certainty that it brings when compared with the old war risk exclusion. We're also likely to see a clearer picture in terms of market adoption following reinsurance renewals on 1st of January. Reinsurers are generally going to be interested in ways to manage systemic risk and may well require specific clauses to be adopted by their insurers. And to a certain extent, it will therefore be reinsurers who dictate the way forward on the issue. We might also see government intervention in some other jurisdictions as governments look to manage the risk of large cyber losses. With the recent talk around whether government should potentially be taking on some of the underwriting or insuring of cyber risks, you can see how government intervention might be necessary to address that. And whilst it's not something we want to happen, it might end up being a large systemic loss, like NotPetya, that kickstarts other jurisdictions into adopting war risk exclusions. That's also likely to be when we first see war exclusions being tested in the courts, which is when we will probably start to see how these clauses are interpreted. And separately, there's the development of cyber war insurance products, which will seek to address the cover that's excluded by the war risk exclusions. The Lloyd's market obviously already includes insurance products for traditional war risk exposures, and we know there are insurers who have already announced that they are developing a product for cyber-specific war risks. Now, we don't know what that will look like, and to some extent, that will be dependent on what cyber policies are excluding. We've also already got 2 cat bonds in the market, which look to provide cover to organisations for catastrophic losses arising from cyber attacks. Now, they aren't necessarily linked to war or state-backed cyber attacks, but they are similarly concerned with large catastrophic losses. So to conclude, NotPetya and Merck demonstrated the potential risks of global systemic loss in the cyber insurance market and explains why Lloyd's wish to manage and control that risk. I think it's fair to say that most of the market has agreed that systemic loss for cyber policies is something that needs to be carefully managed, and Lloyd's and the LMA have taken the initiative to do so. It will be interesting to see how this develops and evolves in the next year and years to come. So we realise that's quite a lot to take in. I'll hand over to Harriet now to deal with any questions we might have received.
Thank you very much, Jacqui. Questions, perhaps not, because the subject is so wide, but a number of observations which to some extent replicate what you may have already said, but I'll repeat them anyway in the time we've got. I mean, some have observed that managing systemic loss for cyber policies is a tall order and possibly unrealistic because of the numerous unknowns. Attacks are unpredictable and their effect is huge. You only have to consider the Merck situation to see the impact of such attacks. Of course, the Lloyd's market is only part of the picture, but what about the company insurance market? The court's approach to clause interpretation and whether or not the approach taken by the judiciary in the UK may be or may be not replicated by the approach taken in the States. There is obviously a lot more to debate on this particular point, and we can't do that here. But we do propose following this up with a later session sometime in the new year, and when the drafting dust has settled a little, and we look forward to any commentary that others may have in the meantime. Jacqui, do you have any views on that?
Thanks, Harriet. Yeah, I agree with that, and I think it's a topic that is being discussed and considered by more than just the Lloyd's market now. The companies and other jurisdictions are also considering it too, but it's certainly a topic we'd be very happy to continue discussing and debating with anyone that wants to. So please do get in touch.